Hello and welcome to Equities Bank. My name is Jonas Thulin, and I will try to rush through just a few slides, updating you on our house view and what we're thinking about the world and about the pivot, etc., peak hawkishness, etc., etc. The methodology is the same as always. We are a house that are working completely with econometrics and quant, and from there we derive our house view and our investment thesis, even the impacts of the upcoming US midterms that I will come back to briefly. In terms of the overall strategy and forecast, they remain the same. We've been bullish on the end of the year in terms of an equity perspective. We start to add that into our portfolios from June. June was our trough in global equity markets, which we're quite happy that we're able to maintain that trough, because obviously when we get a little bit more wind in our sails, it's all very good for the portfolios. In terms of Fed Reserve hawkishness, pivot, peak yields, peak inflation, yes, we stand firm by those forecasts. Now we derive just how we look at this, but also in terms of positive Q3 earnings surprises, troughing earnings revisions, price target forecast, economic momentum. Yes, we are still in that camp. Note though that when we talk about economic momentum, we are referring to the economic momentum where we are invested, i.e. pretty much everywhere apart from the Eurozone. So in terms of what we put in bold, yes, we are still overweight global equities. A little bit of a cheap call in the sense that obviously a year when global rates are performing equally as bad, it's quite easy to make a call to make, but the call that we made throughout this year. Weak is stocky, we're giving back some of that. We have readjusted the portfolio slightly, so we have more euros than dollars before, but still that's our view. And also that we bought US treasuries to really put our foot down in terms of where we stand on peak yields, etc., etc. That's actually so far working quite well for us. Now, in terms of this document, we are still arguing heavily for tactical asset allocation being more important than strategic. We do believe that US CPI is firmly behind us in terms of the peak. There's a lot of equity option plays around the data that comes out on Thursday, which one should be aware of when we go into that in terms of equity momentum. Also, just a Swedish note that yes, we're going to have appalling Swedish macro numbers this week, but that said, that has been pretty much priced. We weren't the only ones to forecast this back in January, at least amongst the market participants. I think we were the only bank who made this forecast. But for us, it's actually more interesting now to start to look at the other way around the corner than to revise forecasts up and down, because that's sort of that's pretty much done. In terms of strategies we've implemented, we still firmly believe in a soft landing, energy crisis. We see a Republican major power grab in terms of the midterms. We're calculating that they're going to take both the House of Representatives, which is an easy low risk calculation, but also a bit higher risk in terms of the Senate, and this might have implications. Think yields down, biotech up, etc., etc. And that's what we put in our portfolio. We will see how that fares without having any further political views on that call. From the peak in the US CPI, yep, that's still in the books. Fed peak hawkishness is behind us in fixed income markets. That's quite important to us. And then we're not looking about the yield levels, we're looking at probability levels, which is also quite important. The Fed pivot, we think that has occurred already in fixed income markets, and it's started to occur in the equity market. And pivot for us is not the fact that they're going to start cutting rates. We knew they're going to cut rates by the summer before we even started hiking, going back to February, March last year. But it's also quite interesting to see how this is shifting the markets now. We believe that macro and financial conditions are in a fight of being the paradigm that runs the equity market, and we are severely in this kind of blockification world. On the right-hand side, I've listed a few of the equity paradigms that we're looking at in order to find our strategic view on equity markets. All of these are bullish for the equity outlook, i.e. both margin depth, smart money index, equity sentiments, internal structure, sell-offs in terms of measuring exhaustion, the degree of exhaustion, daily trading models, Horrible liquidity ratio, earnings revisions, and so forth. And they are all supportive of equity markets. So for us, the equity rebound has been measured, it's been calculated, it's been predicted, and it's not really a surprise. If it holds, that would be great. We're not in this, is this a bear market rally or whatever. We follow data, and as it was very well structured, we went full on back in June. And we're obviously very happy that that trough holds for our global equity portfolios. And also, we're quite surprised so far that with the strength of the US economy, but I'll come back to that. I won't spend too much time on this, but really just to home in that tactical asset allocation is far more important than strategic. That is the case because both equities and fixed income are falling in value. Hence, you have to work with your positions, and we found it to be easier to do that on the tactical asset allocation side rather than the other side. Hence, that's where we put our overweight, and we stick to that. In terms of performance, we all have our own individual benchmarks, and these are ours. It's put in Swedish, but this is a pencil low risk and pencil medium risk, global equities, global sustainable equities, interest rates, and sustainable interest rates, and alternative investments. And we're fortunate enough to keep on performing better than our index and also listed peers in terms of more allocation products that are out there with the same equity allocation. But this is something we're still working on quite heavily, as you can imagine. We're very happy that we are in the lower region, but still making our long-term or medium-term return on in terms of different allocations. So a low risk should theoretically do about 3 to 5%, medium risk should do 5 to 7%. So we're just barely making this lower range, which is I think quite interesting and quite positive in a year when obviously rates and global equities are doing what they're doing. Now, in terms of global equities, for us, we're working quite heavily, as you're aware of, in terms of currency risks. We've shifted out of dollars more into euro, which were good that we did before Fed, but still, this is the case. And we delivered some 8-9% better, and less driven by FX, I should say, and more driven by the underlying equity holdings as we shift away from dollars, and we sort of saw that peak run going back a few weeks. And we have linked to cybersecurity, biotech, etc. A lot of these factors are helped by the bet from the market that Republicans would take over the House of Representatives, especially, for example, biotech, and also obviously big tech as well in terms of cybersecurity and battery tech, etc., etc. So it will be interesting to see how this plays out, and there will be more details in the pod, but just as I mentioned that pod is done in Swedish, so it might not help you too much, but we will have a lot more information in there, and just drop me a note and I will send you the English transcript to that pod, which I have just completed writing. In terms of strategies, yes, still soft landing camp. The labor market is indicating, yes, you can keep on hiking rates. In terms of the election, yes, Republicans will take the House of Representatives, might also take the Senate. The market is fully prepared for this. There are a lot of caveats to this in terms of what's going to happen to the budget ceiling that comes up next summer. Will this be a lame duck session where the Democrats will push through legislation in order to avoid Republicans being able to squeeze in their legislation and force Biden to agree with it in order to avoid the debt ceiling? Yes, that's what we think. Does this also mean that some of the tax incentives by Trump might not be, that Biden reversed might actually be re-reversed? Yes, probably. I.e. look at big tech, look at biotech, etc., etc. So we don't really have a political view on this, of course. Our job is doing the asset allocation, but it's also quite interesting to look at some other legislative efforts out there from Biden in terms of, for example, clean energy. We think that legislation would not be reversed, given the fact that he can veto it. So you really have to go through sector and sector here and make sort of plausible bets on what has been communicated, and that's what we're trying to do, and that's what I've been writing in the transcript. But at the end of the day, this would probably be a Republican victory in terms of the House of Representatives and maybe even the Senate. Now, I should also mention that we think the yields will come lower due to this, and that is in regards to the fact that we think that, and the Fed is obviously aware of that, it will be hard for Fed to keep hiking. That might cause a big recession. You have to have a fiscal package. Obviously, that's going to be difficult with a divided Congress and president. So the Fed might not be able to hike as much as they were previously. So they try to front run the elections, i.e. hike as much as possible. And then after the midterms, they can sort of move back a bit. And that's what's been anticipated by the rate market. It has been called a pivot. It might not be the causation being what I just explained, but it's certainly happening at the same time. That said, let's move on to inflation. I have a huge bunch of the inflation graphs here. I will not go through them all, but actually I will go through them all, but very quickly. In terms of break-evens, the peak from March is holding. We can't really see the petrol station expenditures being sort of alerting an upside. We look at arithmetics factors of the CPI. We know that the base effects turned negative on the 22nd of October. We look at the inventory channels, speaking quite clearly for lower CPI numbers, i.e. we have rebuilt the inventory so much that we need to slash prices in order to get rid of the goods, like Nike, for example. We look at the Fed's own preferred inflation expectations measurements. Yes, we see a peak. We can't really see the 10-year forward break-even move on the upside. We look at owner equivalent rent, and we can see that given the rate hikes and given the price situation, we're going to peak price. That's already happened in various different measurements that we run on that, and that will lead to a peak in the owner's equivalent rent, and that's important because it's about 30% of the rise in CPI. If you look at how the policymakers are manipulating the break-even market by playing around with the supply and demand of the actual papers that we trade, like TIPS, for example, or nominal yields, you can see that they were quite effective back in the pandemic to push out papers in order to make an effect that you started pricing higher rates, i.e. you got rid of the deflationary pressure. And now we can see small bursts of this, so they really want to maintain the 10-year price inflation of about 2.5%. Now, supply bottlenecks clearly collapsing in front of our eyes. Do we believe in deflation? Nope. But certainly that the inflation will come lower and lower, and which is not really any surprise, because if you look at the underlying price pressure, there was really a peak, as I've been pointing out, in March, and we still can't really see a challenge to that peak. And also, if you look at the Fed's underlying inflation, their own inflation model, you can really clearly see a downside. Now, you can also argue this model has been completely thrown out the window because it's been horribly wrong. But I think there are some good reasons for that. One being that the inflation rates that we see might not be 100% sticky. And therefore, the way the model works, it doesn't capture that until it's more traditional, i.e. more stickiness in the CPI numbers. That said, we'll have to see what happens. What we can note a bit more timely is the trimmed mean has also peaked and coming in lower, which is good actually for the peak inflation call. Now, in terms of prices paid versus prices received, downside, demand supply factor, downside, labor share downside, we think the US will follow Brazil or China. They are obviously front running the market from the whole commodity race, but it's not surprising the US will follow, and then in 6 months' time, Europe and so forth. Also on the wage side, we can clearly see this kind of peak wage pressure being behind us, also on the price plans. If you look at compensation plans versus price plans, you can see that price plans moved up quite rapidly, but compensations never quite followed. There might be some readjustments here, but the gap between these two has been very big, i.e. there's too few signs to prove that there's a really sticky wage inflation going on in the US. It might just be they're actually going to disappear as quickly as it came. We have to wait and see, but this is obviously a reason why the fixed income market can take it a bit relaxed on this data. Now, in terms of inflation expectations, yes, they're also coming lower, break-even curves coming lower. And also, do not forget, from a Swedish perspective, that US inflation is 150% more demand-driven than Swedish inflation. So really, inflation is not inflation, and we think that the US inflation will continue to roll over. Not so much in terms of the Swedish or European, but then again, it's a completely different ball game here in terms of we don't really have a demand-driven inflation, but more of a supply-driven inflation than the US, clearly from looking at the numbers. So it's all a bit different in that sense. Now we have the pivot talk, and there's been a lot of talk here. I just put in here a few articles that break out the dovish hedges, the global central bank hawkishness, inflation both peaked. They started the dovish Fed pivot in late October, i.e. the market started pricing that in. You have a more pivotal meeting, this one and the last one. You can see the number of news articles writing about the pivot is increasing. Now, for us, it's quite important to remember this, that a pivot doesn't mean change of i.e. doing cuts. In that sense, it's enough to sort of just like you're riding a skateboard, you have to sort of hat the skateboard, you know, get on the right trajectory and right direction. And we think that's what's happening. There was some confusion of the Fed in terms of the Fed's statement being dovish, and what Jeremy Powell was quite hawkish. We think the Fed FOMC statement will be proven right in this context. But we have to wait and see that. This all mean that the market moved up a little bit given the statement, but you can barely see it on the 2-year, 3-year, on the 5-year, 7-year, 10-year, further out, no reaction, lower in, or further in, no reaction. So you had some very, very small reactions in terms of the yield curve. Obviously, we already knew that we're going to cut rates going into the Q3-ish of 2023, and the major hikes are behind us. So really what Powell said in our mind is that yes, their own dot plot said they're going to hike to 4.5%, 4.6%, and that's too low. That's pretty much what he said. The market was already priced up to 5%. So pretty much just threw in the towel and said, you're right in the market, we're gonna hike more than we said. But that doesn't mean that the market will price in higher rates. i.e. if you look at the Fed fund future curve from the non-farm payrolls data, it actually come in lower. So we're pretty much done with this in the fixed income market. The whole language, though, means that the Fed, who has been signaling more dovishness from the FOMC statements, is still signaling a very dovish, or a lot more dovish sentiment, and that's really sort of building the foundation of what's going to come next, which is obviously the pivot, and which we think occurred in sort of first or second week of October. i.e. the likelihood of 100 basis points move in December, 75 basis points move in December, was pushed away by the probability of a 50 or even a 25 basis points hike. This is the whole pivot, where you sort of have to readjust given the direction you're looking at, like you're on a boat, for example. You don't change the direction, you go back home. You might have to realign your trajectory on where you actually are heading. So this is what happened. This is the pivot, and this is why media start writing that, you know, we passed peak hawkishness, the pivot is behind us, etc., etc. And this is really the trigger behind that. The Fed fund future said, no, you're not going to hike. This is going to be a lower hiking point. They might go a bit higher than you said before, but then again, you were still lagging the market, so it doesn't really matter to us. And this is obviously very beneficial for the equity market. And we were fortunate enough to anticipate this and front run this going back to June. So obviously the equity market is treating us quite nicely for the time being. We believe that the 10-year yield will come lower. We're looking at 375-ish going into the new year as things stands today. We'll have to see if this holds. This whole idea that the Fed will cut rates has obviously been in the market since the second quarter of this year. Again, this is why we could front run this whole thing. The difference between 12 and 25 of 24 months in terms of hikes and cuts from the Fed, as quantified here by looking at Fed fund futures, is 3 cuts until to the beginning of next year, so the third quarter of 2023. We would have 3 cuts, i.e. about 75 basis points. This is what's been priced in the market. It might be wrong, it might be changed, but this is what we have to work with. And as soon as people start to see, i.e. the equity market being the last one to see this, that they can't push as far as or as hard as they have done, given the fact they have a midterms. And after the midterms, you're going to have a lot of more difficult time to save the economy. They have to front run this as heavy as they can. And that's sort of what happened. And then you saw what happened in Fed fund futures, i.e. the shift that happened in October. If this holds, great, equity market will continue to climb. If it doesn't, then we take it then. But this has been our case, and this is where we stick our money for the time being. And this all means that when they hike rates, obviously you're going to have tighter financial conditions. It's very well maintained in the US and not so much in Europe. Our equity strategy for the entire year has been to avoid Eurozone equities and to put them more on the US, and we stick to that. There are some real signs in the real economy that the financial conditions tightening is starting to have an effect in terms of manufacturing CMI data, which is good, I guess, because this is what they wanted to achieve. But we don't see any more substantial negative effects so far. Now, we're overweight equities, and obviously last week, the global benchmark after the Fed rout was down 2.8%. We took a bit on the chin there, we lost 0.4%, so obviously a lot less. We are still heavily involved in Latin America, India, and last week, don't forget, China had its best week since 2015. We finally got the rebound that we've been waiting for. Is it enough? We have to wait and see, but so far, so good, up today again. And this is the reason why we've been holding on to China to some extent. Now, if you look at the internal equity market structure, we think the data range indicator, building on basically the difference between institutional and retail money, is showing an indication on the upside. The margin depth is also doing the same thing. In terms of the equity sentiment, it's very, very high. And even when the market turned lower following the Fed, it didn't budge, so we're still as positive as we were before Fed, which is quite interesting when you think about it, really. I think so, at least. In terms of risk indicators, there we're actually breaking over the zero, so we added on more growth equities ahead of the GDP numbers, going back a few weeks. In terms of highs, lows, advanced declines, bullish bears, etc., we're actually still making very nice levels, even though the spot market was down a bit, but we're still on very, very lofty levels. The market is more stressed about missing the upside than about avoiding the downside. So more prone to buy than to sell. In terms of sell-offs, we don't really have to measure the strength of that. In terms of the fourth quarter, this has been our roadmap, and then we're going to have a sharp rebound. And it's quite interesting to see how strong this quarter is compared to previous years and previous history. In terms of risk models, obviously we see the upside as well. In terms of flows, it's quite interesting to see that we actually get some good flows coming into the equity market. This is a bit tricky curve that I made here to really see the second derivative, really stressed indicators to see the turning points, which I quite like to catch. We can also lean back and just look at fund flows, and you have that in this graph. You can see the rising equity flows, which obviously is supporting equities as well. Positive gamma doing its trick on its own, so that's always good. And in terms of Goldman Sachs bear market indicator, we can see there's no risk of a bear market right now, which is obviously positive as well. So why equities in the first place? But as I mentioned before, we like to trade growth, and we like to trade growth in terms of where we are. This is a graph we're looking at the S&P versus the ISM. We know that in terms of the equity market, ISM has to drop to below sub 40 in order to validate the current level of the equity market. It might not. If it doesn't, then the equity market has been wrong. If it does, it's already priced in. From a risk-reward point of view, given the internal factors that I just went through, for us it's a clear game of increasing equities in that sense. It's quite interesting to see if we repeat 94-96 event that we saw falling equities, and then the real economy finally followed through, and then the equity market shot off to the upside. So I think that something similar will happen so that house view is maintained. The trough in global GDP is good to see. The beginning of the trough in earnings revision is good to see. We're not too concerned about this little drop-off, given the fact that corporates are indicating that they are still more bullish than the consensus. And this has also been driven by the economic cycle, which I can show you from various surprise indicators, all showing upsides in the economic cycle. So the US is clearly still in an expansionary phase, actually accelerating in the fourth quarter from the third quarter, which I anticipated they would actually slow, but I'm a bit surprised so far. Now, obviously, the fourth quarter is still young, but I will show you in a couple of seconds what I mean with that. In terms of recession risk, it's still below 24%. It's actually right at 24% for the next coming 12 months. We still cannot believe why people would try to make the argument about 2022 recession, because there was never priced in the market. It never got any traction. It became more of a reason to try to explain other stuff that went on in the equity market. There was no real risk for recession in 2022. We can't really see one going out to third quarter of next year, actually, as things stand today. If you look at the next 12 months and look at the Fed's own recession model, which has a good track record since the 1970s, you can see a recession risk of 24%. In terms of hard data, which you can put alongside all these fancy GDP models and recession risk models, you can look at the lumber price, you can look at in China electricity use, cement use, or steel. You can look at US railroads or the shipments of containers if they're loaded or unloaded. You can look at the volume growth of trade. You can look at the port activity. You can't really see a slowdown anywhere in this hard data, which is sort of timely, but also quite interesting to look at compared to the underlying macro models. Now, in terms of the highly sophisticated and high-frequency macro models that we run for the US, you can actually not see a slowdown going into November. You can actually see that October is delivering steadfast economic growth of between 1% and 3%, and this blue is actually up on 4% now. So it doesn't seem like the fourth quarter will slow down for the time being. I.e. Fed can keep on hiking, but also the people that called for US recession in 2022 probably have to give this up for sure now. And we can focus more on the underlying macro for the equity market. Because obviously they're going to keep on hiking from the Fed, but that's already been priced. We already priced the recession, i.e. the upside starts to look very good for us. The same argument we made back in June actually. In terms of more sophisticated business confidence measurements, they are still bullish. The SAM rule is still indicating 0% the likelihood of a recession, so all that is good. If you look at the data that actually define US recessions, they actually improved since last week. So we're still in this improvement camp, which is quite interesting, going back to the cause that some people tried to make for a recession. Now, obviously, it depends probably on what portfolio you're running, I guess. But for us, this has been a good year, given that rates are doing so as poorly as they are, to work on the global tactical side of things in the equity market. Now, this whole blockification idea, I think this picture is quite useful to think around, is that yes, in Europe we're going to have a very dire economic winter, and Sweden as well. But one should not forget this happens in a global context of re-accelerated growth, i.e. this blockification that we've spoken and written so much about is happening right now, right here. I.e. you're going to see an accelerated global growth in terms of China, Japan, US, etc. And you're going to have a deceleration, if not a recession, in Europe and Sweden, for example. This is not to be confused about equity positions. In Sweden, for example, we're trading more on US macro. If you look at large cap and also a lot part of the mid cap sector. Maybe one should think a bit differently on the small cap side, but that's a different story. So we're still optimistic on Swedish equities. It's in the portfolios. But this whole blockification will be a bit of a trick, I think, to comprehend. The forecasts are the same on the global growth. We're still growing quite rapidly. There are no downsides here in terms of volume, in terms of global credit impulse indicators also quite positive. So it's all good in that sense. So it's quite interesting to see how things are developing. Now that was all from us. So I would like to thank you so much for your time and patience. So pretty much the house view stands it is. We think the peak hawkishness, peak inflation, and the pivot has pretty much been dealt with in the markets, we're quite happy for that because that's what we forecasted, and we're going to keep our eyes on, see where things are developing, going further down the line until we start to approach what's going to be sort of the next game, which will be the Fed cut in rates, which is timed, already priced in the market to be happening Q3 2023, and one should not forget that that was already priced about a year ago when we started pricing the hikes, so the cut was priced in immediately. So that's not really the new thing. What's new right now is that the trajectory of the Fed has been tilted downwards for the December meeting, obviously linked with the US midterms that comes up tomorrow, Tuesday. So I thank you so much for your time, and I'll be back in about a week. Thank you so much.